You found the house. You got approved. You signed the papers. $400,000. 30 years. Done. Except it's not $400,000. It never was. By the time you make your last payment, you will have paid the bank over $860,000 for a $400,000 house. More than double. And the bank knew that number before you signed a single page. You didn't. By the end of this video, you'll understand exactly how this works, and one move that most homeowners never make that cuts that number almost in half. Stay with me. Here's the mechanic that nobody explains at closing. When you take out a mortgage, the bank doesn't split your payment evenly between interest and principal. They front-load the interest. In the first years of your loan, more than 3/4 of every payment goes straight to the bank as interest. Not to your home, not to your equity. To the bank. Let's make this real. After 5 full years of paying your mortgage, you've sent the bank $145,000. How much have you actually paid off your loan? $27,000. 5 years, $145,000 paid, $27,000 toward your house. The rest, $118,000, went to the bank as interest. And the tipping point, the moment when more of your payment finally goes toward your home than toward the bank. Doesn't happen until around year 18. Around year 18. For nearly 2 decades, the lender collects more from your payment than you do. And here's what makes this worse. Most people never finish their mortgage. The average American moves or refinances every 7 to 10 years, which means they restart the clock. Back to year 1, back to paying mostly interest, back to building almost no equity. This is how standard mortgage amortization works. And it benefits the lender far more in the early years. At today's average rate of 6.46%, a $400,000 mortgage costs you over $460,000 in interest alone over 30 years. That's the house, plus another house, paid to the bank in interest, and buried in your closing documents in a section called the amortization schedule was a table showing you every single number, every payment, every dollar of interest, the exact date you'd finish. Most people never even open that page. And that's exactly why the math keeps working the way it does. Now here's where this changes. Because the math that works against you can be made to work for you with one move. One extra payment per year. That's it. If you take your monthly mortgage payment and divide it by 12, then add that amount to every monthly payment. You make one full extra payment per year. On a $400,000 mortgage at 6.46%, that single habit cuts your loan from 30 years to roughly 24 years. 6 years gone. And saves you over $100,000 in interest. One extra payment per year, $100,000 saved. This is move 1. Move 2, understand what you actually own right now. Most homeowners think of their home as their biggest asset. But In the early years of a mortgage, the lender owns most of it. Your equity is the difference between what your home is worth and what you still owe. After 5 years on a $400,000 mortgage, your equity is roughly $27,000 on a $400,000 asset. That's less than 7%, which means if the housing market drops, even slightly, your equity can disappear completely. So here's what to do right now. Log in to your lender's portal, find your current loan balance, then find your home's estimated value. Subtract one from the other. That number is what you actually own. Not what the bank tells you at closing, not what Zillow says your house is worth. What you actually own. This is Move 2. Know your real number. Move 3. And this one, most homeowners never consider. Every extra dollar you pay toward your principal saves you multiple dollars in future interest. Because interest is calculated on your remaining balance. Every dollar of principal you eliminate today stops generating interest for the remaining life of the loan. One extra dollar now could save $3 or $4 later. Even $100 extra per month on a standard 30-year mortgage saves over $30,000 in interest and cuts years off your loan. You don't need a windfall. You need a habit. This is Move 3. Now, let's connect everything. A mortgage is not a fixed cost. It's a negotiation you're having with math every single month, whether you know it or not. Most people lose that negotiation for 30 years and hand the lender hundreds of thousands of dollars they never had to pay. Not because they couldn't afford to do differently, because nobody showed them the numbers. So here is what to do this week, not someday. This week. 1. Find your amortization schedule. It's in your closing documents or your lender's portal. Look at how much of your next payment goes to interest versus principal. Let that number make you uncomfortable. 2. Calculate one extra payment per year. Divide your monthly payment by 12. Add that amount to every payment going forward. Label it principal only when you pay. That one habit could save you 6 years and over $100,000. 3. Anytime you have extra money, a bonus, a tax refund, anything, consider sending it directly to principal. Because paying off 6.46% debt is a guaranteed 6.46% return. No market, no risk, no volatility. You can spend 30 minutes understanding how this math works and change what this loan costs you for the next 30 years. Which means the only person who is going to change what this mortgage costs you is you. Not your realtor, not your bank. You. The math is available to everyone, but almost nobody looks at it. Now you have. Next video, why even people with good salaries feel like they're falling behind every month. And it has nothing to do with how much you spend. See you there.